Hey everyone, and welcome back to the Biotech Investor channel. If you love the thrill of biotech investing, then this video is for you. Today, we're dissecting the wild ride that was Madrigal Pharmaceuticals' recent FDA approval. Get ready for leaks, reversals, and a whole lot of investor drama. Let's go! Let's rewind to the beginning. March 14, 2024. The American Association for the Study of Liver Diseases accidentally leaked a statement that seemed to suggest Madrigal's drug resmetirom had scored FDA approval for NASH, a serious liver disease that we covered in our last video. Understandably, this sent the pre-market stock price through the roof. It's a classic of buy the rumor mentality in action. But then comes the rug pull. The AASLD issues a clarification, a huge blunder on their part. They had no insider info on the FDA decision and basically jumped the gun. Investors who'd bought into the hype watch Madrigal stock plummet. Now there is fear and uncertainty all over the place. Here is where things get really interesting. Just hours later, Madrigal stock trading was halted. Unlike a true plot twist, the FDA does approve resmetirom. Naturally, Madrigal stock shoots back up, but here's the thing, it doesn't sustain that momentum. Why not? Let's break it down. The whole leak fiasco damaged investor confidence. Even with the actual approval in hand, people are very hesitant. Then there is Madrigal's public offering, just days after the approval at $260 a share. Offerings tend to create temporary downward pressure. It's all about supply and demand. So, what was this offering about? Here is a breakdown of Madrigal's offering and its implications. Madrigal offered two things: shares of common stock, and this is straightforward, ownership in the company, and pre-funded warrants. These give the holder the right to buy additional shares at a later date for a price very close to the offering price. This is a bit more complex, but essentially it's another way for investors to get in without causing immediate share dilution. Madrigal aimed to raise around $600 million, and this money is often used for things like commercializing a newly approved drug, marketing, building a sales force, etc., and potential acquisitions or licensing deals to strengthen their product. Investment banks act as the middlemen in these offerings. They buy the shares from Madrigal and then resell them to investors. It's likely major banks like Goldman Sachs and JP Morgan were involved, but the company would disclose the specifics in their filings in the near future. These offerings often attract big players like hedge funds and pension funds. We won't know the exact buyers without further digging, but these are the types of institutions usually involved. Madrigal initially announced a $500 million offering, then upsized it to $600 million. These offerings closed within a few days of announcement. The expectation is that once the offering is closed, the price should trade again without any downside pressure. Last month's market sentiment, we've seen most of the market trade down as there are no rate cuts from the Fed on the horizon. Where do we go from here? Let's make some assumptions. We'll stick with 20,650,000 outstanding shares, and we will be using price to sales ratio in this case. Biotech valuations vary wildly, especially pre-commercial ones. For the sake of this exercise, we will use a range of PS ratios. Low end, price to sales of 5, moderate, price to sales of 10, and high end, price to sales of 15. Interpreting the results for the sake of short term, let's look at the low case scenario or worst case scenario. Price to sales of 5. If Madrigal achieves $12 billion in annual sales, this translates to a potential share price of approximately $581 a share. Is this doable? Currently, a one-year treatment costs $47,000, and with the first target audience of 350,000 patients, which is what Madrigal has been sharing in their latest presentations, they're targeting to make around $16 billion in sales for 2025. That sits between our low case of $12 billion and our medium case at $24 billion, which is quite a lot. If they can reach their projections for next year, the stock price should be around $600 per share by mid to end 2025. I personally do not believe that we will reach that price. I believe that Madrigal will be bought by a major pharmaceutical company before the goal is reached. Madrigal has a very limited pipeline with no other products in clinical trials. Thus, it would not make much sense to continue in this journey, trying to market this one product and trying to survive all the sales obstacles that these major pharmaceutical companies already have figured out. When do I expect this buyout to come? I believe that in order to sell the company for top dollar, Madrigal needs to prove their sales, and this may take a couple of quarters. In regards to the earnings happening next week, sales started after April 1st, thus we do not expect to see any revenue for Q1. I will be looking to hear from the CEO about their efforts on building their sales pipeline and getting approvals to sell in Europe and Japan. I have added more in the recent dip and happy to be able to add at a lower price than the post FDA approval offering at $260 a share. This whole story is a fascinating case study in investor psychology. We see the power of rumors, the fear of missing out, FOMO, and the delicate balance between hype and genuine long-term potential. It's a good reminder that biotech is all about risk versus reward. If you like these deep dives, hit that like button, subscribe, and let me know what biotech stocks you want me to break down next. As always, I'm not giving financial advice, just analyzing a crazy situation. Where do you think Madrigal goes from here? Drop your thoughts in the comments. Thanks for watching. It's been a pleasure.